Welcome back to Squawk on the Street. Let's talk a little about commercial real estate, shall we? It's a sector, of course, that has performed fairly well in today's economy. And we do have an exclusive interview. Bob Sulentic is CBRE's Group President and CEO. Nice to have you here.
Good to be here, David.
I know you report earnings a few weeks down the road, but how would you describe the overall environment in terms of what you're seeing, in terms of leasing and commercial activity right now? Obviously here in the largest single office space market in the country, but nationwide.
Well, David, as we got to the end of 2019, we saw a couple different things going on. Sales here in the U.S., commercial property sales were really strong, up 11% year over year as independently reported. So really strong sales. A little bit of downward pressure on the leasing markets here in the U.S. and around the world. We think that came from a little bit of a lack of confidence by businesses earlier in the year. We've seen that turn around. We went out to 50 of our largest tenants that we represent in the leasing market recently, companies you would recommend or you would understand their view on. And these are companies that said they're going to lease more space in 2020 than they did in 2019, some of the biggest companies in the world.
Yeah, well, we're seeing that, I would assume. We spent so much time on it in terms of at least the difficulties that company had. It has pulled back from certain ambitions. Has that had an impact at all in terms of what you're seeing for space and for availability?
In the short run, we think the pullback by WeWork, which was a huge consumer of space here in New York and London, has had an impact on the leasing markets. But in the long run, we don't think that's a big deal. WeWork occupies less than 1% of the multi-tenant space here in the United States. This co-working trend is very real. We believe over the next 10 years, it's going to go from about 2% of the multi-tenant office space to something like 10 to 15%.
Why?
Because it's flexible. It's you can get into it quickly. You can take short-term leases. Tech companies who are really important in the leasing markets like this, and companies have learned to use it. Landlords want it. We believe it's very real and it's going to continue to grow.
Well, you've launched a competitor of your own to WeWork, Hana, I believe it's called?
CBRE has launched its Hana concept. We're growing that now. We're growing it carefully. We're picking the right markets to go into. We're here in New York. We're in London. We're in Dallas. We're in the LA market. We're quite bullish on the prospects for Hana.
How different is your model financially to WeWork, and are you capitalizing off of their pain right now?
Yeah. Well, first of all, Hana is completely self-funded by our company. It's very oriented towards institutional occupiers as opposed to memberships, individuals. That's where we think the future is. It's suites-oriented. It's got big data security, higher-end finishes. We think it fits the market that the tenants want and that the landlords want. We're quite excited about the direction of that business.
Is retail shrinking its footprint in Manhattan, let's say? And if it is, to what degree, and what's it being replaced with?
Retail's shrinking to a degree because of e-commerce, but retail is very real. If you look at the cities around the world where people want to live increasingly, cities like New York, London, and Tokyo, you simply can't attract people to live in those cities without what they talk about as amenities. Amenities are retail. It's food and beverage. It's places to work out. It's places to shop. Retail is very real. It's going to be here forever, but it is changing. By the way, retail's always changed. That's not new.
Is it being repurposed in a particular way, though? Healthcare, perhaps, hospitals?
Certainly, emergent care clinics has been a repurposing circumstance. A lot of health clubs, lots of different things that are experience-oriented for people that want to live in cities like New York.
Speaking, though, of cities like New York, when you walk around the streets of my neighborhood, and I think my colleagues here, you're going to see an awful lot of empty storefronts. Way more, anecdotally, certainly, than I've ever seen in the last, let's call it, 20 years. Is that going to change? Do rents need to come down dramatically for there to be a market that at least some people feel comfortable trying to open a new store in?
What happened there in New York in particular was that rents accelerated dramatically. They got a little bit out of control. Some retailers couldn't afford it. Some retailers were impacted by e-commerce. Those two dynamics caused some retailers to move out. And in certain markets, once a few retailers move out, then others have more trouble succeeding. I think that space will be reoccupied, repurposed, and in the long run, you won't see that vacancy.
You do believe that that's not a seminal change in terms of we're just going to be living with empty stores?
I don't believe you're going to be living with empty stores long term, and there's not a lot of new retail space being built.
Yeah. Foreign money has been an important component, certainly when it comes to purchases and/or just having adequate capital and liquidity. Has that pulled back at all? We certainly hear again, whether it's Russian investors or Chinese, certainly, and others. And is that a factor in terms of values?
Last year, foreign capital coming into the U.S. to invest in commercial real estate pulled back a bit on a direct investment basis. But last year was a very, very strong year for commercial real estate investment in general, driven by the private equity firms, the funds, domestic funds. Much of the capital they were investing, though, they raised overseas, and there was actually more capital than there was opportunities to invest in.
So Blackstone is staying busy.
Blackstone is very busy.
Well, Bob, we appreciate your taking some time with us. Thank you.
Good to be here.
Bob Sulentic from CBRE.